Very good evening, sir, to all our participants in ALTPORT. This is the Market Outlook Show from ALTPORT Funds, and today our guest is Mr. Kunal Shah. He is a principal officer with 12 years of experience in fund management and investment. He is a committee investment core committee member with Carnelian, and since inception, and he is a chartered accountant, all India rank, and he's in been research in the sectors like banking, insurance, customer auto capital, chemicals, pharma, etc. He is passionate about reading and understanding various market caps. So he is the right person for you to explain the market outlook in today's scenario. So we are want Kunalji to address our clients about this.
Thank you, Vijayji, and good evening to everyone out there. I'll just, before giving the market outlook, do a quick recap of what has happened in the last 18 months or 2 years to kind of set the context. So we peaked out somewhere in September 2024. But before that, from March onwards, only we were seeing a little bit of issues in terms of liquidity, elections, etc. And then eventually it started to boil down at numbers when Q3, Q4 numbers of that year kind of panned out. And post that, there have been series of issues, be it liquidity challenges, be it the tariff-related issues. Operation Sindoor happened in between. Tariff-related issues got a little bit of time extension, but then again, after that time got extended, expired, again tariff-related issues came to power. And then in the same time, we also had a lot of actions on the domestic front where GST cut was done. Income tax cuts have been done in the budget. Also, there were a lot of initiatives that were taken to kind of promote credit growth, all on the positive sides. And, we started to see pickup in the credit growth happening in the last 6 months. Auto numbers post GST cut kind of doing good. We kind of getting done with the deal with the US, which was the most talked thing in the town. And after that, things were looking like okay, and suddenly from nowhere, this Iran war came out of the box, and then again things kind of started to take a toss or became volatile. So in this backdrop, we have already seen almost 18 months to 2 years of we climbing all the wall of worries that I just talked about, and also seeing a lot of positive actions been taken by the regulators, which were starting to show impact and which till date continue to kind of have positive impact. Having said that, still there are two, three things which continue to be a key monitorable. That is crude, that is rupee, and also what happens to exports. Having said that, before giving the outlook, one thing which is very important is the in the value that a company gets ascribed is the cash flow that it generates in the lifetime of the company. So while 1 quarter or 2 quarter earnings do play a role, but 95% of the company's value is so yes, climbing all the wall of certainty as to how this will kind of play out, how long crude will kind of continue to remain where it is, and at the same point of time, what happens to rupee. Having said all of this, we believe it's corrected only because of this uncertainty, and then we have seen a quick rebound. So we might see a little bit of consolidation over here and probably a quarter impacted because in the quarter that has gone by, we've seen raw material inflation impacting margins of the companies, logistical issues kind of impacting margins of the companies, and also to an extent exports kind of got disrupted. But still nowhere there has been demand side issues, green shoot, which is very important. So demand side continues to be strong. Companies to kind of manage the inflation in the raw materials, logistics costs, etc. have also kind of taken price rise, which has to be seen kind of how it plays out. But so far, all the numbers that have came out, be it banks having robust credit growth, be it consumer companies reporting volume growth, be it autoing companies which continue to kind of report decent set of numbers, whether the rise in crude will be passed on to the eventual consumers or not will have to be seen, because there has been a lot of chatters as to this will kind of eventually be passed on post the elections. So that has to be seen. But in this backdrop, probably a quarter earnings may kind of get impacted, but markets have already climbed a lot of worries. It seems to be a market which was very similar to where we were in FY 2022, wherein 22 turned out to be a very difficult year, and then 23, 24 turned out to be very good years. We believe that we are in a very similar phase of markets fag end like FY 22, probably a quarter more. But then something what played out in FY 23, 24 with very high probability, unless something unforeseen happens further from here on, which we cannot model into it, should be a repeat, in FY 27 and 28. So with that, I'll take a pause, Vijayji. So we believe that we are in the fag end of markets like 22 and 23, 24 panned out to be very good years. 27, 28 should kind of play out in a similar fashion. This is a time to kind of build portfolio, not expect returns immediately. Zoom out a little bit, but this that years have turned out to be best years to kind of build portfolio and allocate money to equities to kind of reap benefits later on. We believe we are in a similar stage.
So, as you said, this is the time to build a portfolio and for a longer vision, and you cannot expect a good return in a short term, right? So, any sector-wise allocation that need to be focused on in the current scenario?
All right. So basically, we have been overweight on pharma, API, CDMO theme, because we
Hmm.
believe this is a decadal theme, where a lot of business has been coming to the Indian companies moving out of China from big pharma companies in the US. This is also a sector which has got very minimal to zero impact as to what's happening globally in the world. So that is a sector which we believe should kind of do good. On the domestic side, there are sectors like banking, financial services space, again, where insurance is kind of doing very good. That is again a sector which looks very promising. Growth is coming by. On the credit side, again, select private banks should to kind of do good, because credit growth is something which is kind of picking up. Deposit growth, which was lacking, has also kind of picked up. Select NBFCs catering to the likes of SMEs, etc., should also kind of do good. So that is again a pocket which offers a reasonable good opportunity to kind of make money from here on the capital goods side. Power is a theme which is kind of really doing good and has got long runways. Within that, thermal as a segment is something which we are very gung ho on. So again, over there, we are not betting big on the renewables side, but on the thermal side, there are few plays which we believe will kind of which are kind of doing good and which will kind of continue to do good, because again over there, there's a lot of money that has been getting spent across the globe and in India specifically, and there is good visibility basis the order book that they have. There is good valuation comfort as well, commensurate to the earnings growth visibility that they are providing for. So again, that is a space which we believe is something which will do good. Again, on the capital goods side, there are segments which will have a lot of role to play in building again, what has been destroyed in the Middle East, right? So again, that is a segment which will kind of do good. On the select
Infrastructure.
auto ink side, again, there are themes, there are companies which are going to benefit from the domestic market, plus the kind of manufacturing shops that they've set up in India to export to their global counterparts across the globe. So they will have growth coming in from the domestic markets, plus export opportunity that is opening up for them. So these are the few select segments and pockets, where there is good visibility for growth, reasonable valuations, and should do reasonably good in the next 2 to 3 years.
Auto, pharma, thermal are the key sectors, I think, to focus on.
Right, BFSI again, yeah.
Mhm. But looking at the global scenario, how strong is the Indian market to be steady? And is there any recovery time that you frame out? Just to give a brief.
So, Vijayji, so see, we did recover quite a bit. I mean, if you see small and mid caps, particularly, which have been having very tough time, and everything has kind of derated in small and mid cap segment in the last 2 years.
Mhm.
Good bounce back in the last 45 days or so. In fact, our shift strategy is also up by around 15% or so in the last 1 month or so. So there has been a good recovery in the last 1 month or so. But yes, having said that, Q1 earnings could be a little soft. The biggest point is whether it is there in the price or not, and that is something which is very difficult to predict. But having said that, in this time, it is very important to zoom out a little bit and look beyond 1 quarter and 2 quarters and look at what is going to happen in FY27 and 28, which gives us a reasonable confidence that we are in good times going ahead in FY27 and 28, and there is no other better story than India to kind of play.
There are few investors who are keen to invest in small cap. But looking at the current scenario, is it right time to accumulate the good quality stocks in small cap, or is it just to stick to large or mid cap?
So,
Any view on that?
Vijayji, it's a buffet out there, to be
Uh,
very frank and honest. Flexi cap funds give the liberty to the fund manager to kind of
mm,
go overweight on mid cap, small cap, large cap, basis his understanding of the markets. Small and mid cap, being the mandate of being in small and mid cap, will always be, kind of focus on small and mid cap companies. So, one's always better to kind of, it depends on the risk awareness that the client has, right? If he's okay with the beta and the volatility that comes with mid and small cap, then obviously it's a good time to kind of accumulate mid and small cap. But otherwise, flexi cap is always better to weather across all the times.
anything that need to be cautioned about the market in the current scenario? Means,
Everything that can be thought of will always be modeled in the portfolio. So,
mm,
risk always comes from something which is not known. As I said,
mm,
we all became very bullish the day US India deal got stuck, because that was the last nail in the coffin, which was kind of remaining, right? And post that, companies in our portfolios like L&T, Kalpataru, etc., were all hitting 52 weeks high. And then suddenly, from nowhere, this Iran war kind of came, right? So,
mm,
risk always comes from something which is not known, and that creates kind of uncertainty. Having said that, immediate things to watch out for is crude, which has a bearing on a lot of companies. And at India level, we are a little insulated because of our current account deficit levels being very reasonable. Still, that continues to be a key monitorable, and how long this kind of sustain. We have seen this during Russia-Ukraine war, crude touching almost around 130, 140 levels. It was there for about 2, 3 months, 3.5 months to be precise, but eventually it kind of cooled off. Base case suggests that eventually this should kind of happen, but in markets, never say never. So that continues to be a key monitorable.
okay. So I think our clients have got a few insight on the current market scenario, fair few sectors, and what need to be done. Anything which, on the data perspective, shows a very high growth story from the Indian perspective that you want to share with us?
Yeah, I think there are many sectors which I talked about, right? All the sectors which I talked about are sectors which are very promising. There is growth and there is reasonable valuation out there as well. So,
Mhm.
all the sectors which I talked about have reasonable valuations, along with good visibility for growth for the next 2, 3 years. So, those all sectors are the ones which I believe is a good place to kind of bet money on.
Mhm. So I think uh, there is enough sufficient information which our client got about today. So stay invested for at least 2 3 years. This is the time for accumulation. There are few sectors which we have discussed, which shows a good potential, and the best fund to be selected to be the flexi cap, where the fund manager has a liberty to jump in based on the market scenario, whether it's a mid cap, small cap, or large cap. And the caution part is already taken care by the fund management, right?
For what
Okay.
is known, it's always there. As I
Yeah.
said, risk always comes from something which is not known. I just gave you an example of,
Yeah.
L&T Kalpataru hitting 52 weeks Y, and then suddenly
Mm-hmm.
this Iran war happens, and the stocks are down by 15-20% in a matter of weeks' time.
Mm-hmm. So it's a nice session with you, sir, and we are glad that you taken a time and addressed our client on the market outlook.
Thank you. Thank you so much. Thank you.
Thank you, sir. Thank you, sir,
Thank
from
you.
all our clients.
Thank you.
Thank you, sir.